Algorithmic Trading, Winning Strategies and Their Rationale by Ernest P. Chan is a practical guide to developing and implementing quantitative trading strategies. Written for traders, investors, and quants, the book focuses on how to design, backtest, and deploy algorithmic trading strategies grounded in sound statistical reasoning and data-driven analysis. Ernest Chan, a respected quantitative trader, shares his expertise, emphasizing both the theoretical and practical aspects of systematic trading. Overview of key themes and concepts. Chan introduces algorithmic trading as a systematic approach to trading that uses pre-programmed rules based on statistical analysis. It differs from discretionary trading in that decisions are entirely data-driven, reducing the role of emotions and biases. Successful strategies depend on rigorous research, backtesting, and implementation. Key chapters and their lessons. Chan explains that algorithmic trading must be treated as a business. Like any business, trading strategies require capital, a solid plan, and risk management. Trading performance is measured in terms of returns, drawdowns, and risk-adjusted metrics, like the Sharpe ratio. It's important to have realistic expectations. Traders should aim for steady, sustainable returns, rather than chasing outsized gains. Chan describes popular algorithmic strategies, explaining their logic, statistical basis, and potential pitfalls. Mean reversion assumes that asset prices tend to revert to their mean, or average, over time. Traders buy assets that are undervalued, below the mean, and sell those that are overvalued, above the mean. Key tools include Bollinger Bands, moving averages, and Z-scores. An example is pairs trading, where two correlated assets diverge temporarily, creating opportunities. Momentum strategies. Based on the principle that assets experiencing upward or downward trends tend to continue in that direction. Traders ride the trend until there are signs of reversal. An example is buying stocks that have shown strong recent performance. Statistical arbitrage exploits, short-term mispricings or relationships between assets. Chan discusses cointegration and correlation as tools for identifying arbitrage opportunities. Breakout strategies focus on identifying price breakouts from defined ranges or patterns, which signal the start of strong trends. An example is trading breakouts from support and resistance levels. Strategy design and backtesting are crucial steps in the development of a successful trading algorithm. Backtesting in particular is essential for validating the performance of a strategy on historical data before deploying it in live markets. Key considerations include avoiding survivorship bias. This means not just testing on assets that exist today, but also considering those that have failed. Overfitting is another critical factor. It's about avoiding the trap of building strategies that perform perfectly on historical data, but fail in live markets due to excessive optimization. Out-of-sample testing is also important. This involves splitting data into training and testing sets to assess the robustness of the strategy. Chan stresses the need for realistic transaction costs, such as commissions and slippage, in backtests to avoid overestimating performance. Implementing strategies is the next step, and Chan walks readers through this process using programming languages like MATLAB, Python, or other trading platforms. The steps include writing code to automate data analysis and order execution. It's also crucial to integrate algorithms with brokerage APIs for live trading. Chan offers practical advice on managing technical issues such as data feeds, latency, and system failures. Risk management is all about capital preservation, which is a primary focus of algorithmic trading. Managing risk effectively is essential to survive in volatile markets. Key risk management techniques include position sizing, which limits the size of trades to reduce exposure to individual risks. Stop-loss orders are another tool, automatically exiting trades when losses exceed a certain threshold. Diversification is also important, spreading risk across different strategies and assets. Chan emphasizes that proper risk management is often the difference between success and failure. Now let's dive into some advanced topics in machine learning. Chan introduces more sophisticated topics for experienced traders. First, we have high-frequency trading, or HFT. These are strategies that exploit ultra-short-term inefficiencies. Then we move on to machine learning. This involves using algorithms to identify patterns in large data sets and improve predictions. Practical examples include using decision trees, k-means clustering, and regression for predictive modeling. However, Chan also warns readers about the risks of machine learning, such as overfitting and model instability, especially in financial markets where relationships can change over time. Key takeaways. Quantitative strategies must be rooted in logic. Successful strategies are based on sound statistical reasoning, not speculation or intuition. Backtesting is essential. Traders must rigorously test strategies on historical data to assess their validity and robustness. Avoid biases, such as survivorship bias and overfitting. Risk management is critical. Limiting downside risk is as important as generating profits. Proper position sizing, diversification, and stop losses ensure capital preservation. Focus on execution. Strategy design is only half the battle. Reliable implementation with proper infrastructure, such as low latency and clean data feeds, is essential. Simplicity outperforms complexity. While advanced machine learning tools can be powerful, simpler models often perform better due to their interpretability and robustness. Practical applications. Traders can use the book's concepts to design and test their own systematic strategies. Understand when and how to apply mean reversion, momentum, and breakout techniques. Integrate risk management into their strategies to ensure long-term sustainability. Who should read this book? Quantitative traders. Individuals looking to design and automate systematic trading strategies. Algorithmic traders. Those interested in coding and implementing strategies for live trading. Investors. Anyone seeking a deeper understanding of data-driven, rules-based approaches to trading. Financial professionals, analysts, or quants looking to bridge the gap between theory and practice. Final thoughts. Algorithmic Trading by Ernest Chan is an invaluable resource for traders who want to develop, backtest, and implement systematic trading strategies. By emphasizing statistical rigor, risk management, and disciplined execution, Chan demystifies quantitative trading and provides a practical framework for success. This book is not just about building profitable algorithms. It's about understanding the rationale behind strategies, managing risk, and maintaining realistic expectations in a world where markets are unpredictable. Hit the like and subscribe. It helps grow the channel.